Did you see the Indian markets hit an all-time high today? Let's understand why. The United States Federal Reserve is the most influential central bank in the world. Anytime the Fed makes decision on federal funds rate, it has massive influence on emerging markets such as India. Now, in response to inflation hitting a 40-year high of 9.1% in the US, the Federal Reserve has undertaken a series of interest rate hikes, increasing its policy rate by 525 basis points since March 2022. Yesterday, the US Federal Reserve opted to maintain the interest rates at a steady 5.25 to 5.5% for the third consecutive time. Now, this decision comes on the back of Fed acknowledging inflation has fallen over the last 1 year, with US inflation falling to 3.1% in November. Now, in a very noteworthy development, the Fed chair also provided a very clear indication that the central bank plans to initiate interest rate cuts in 2024, projecting a reduction of 75 basis points over the next year. Now, this is good news as interest rate cut implies a softened US dollar and bond yields. On the back of the Fed's decision, the 10-year US Treasury yields have dipped below the 4% mark, a notable decrease from the multi-year high of 5% recorded in October. Also, the US dollar index, a measure of the dollar against 6 other currencies, declined to 102.9 on December 13th. Now, when the Federal Reserve announces rate cuts, foreign investors tend to increase their investments in emerging markets like India in a lookout for better investments. Looking ahead to 2024, the Federal Reserve's shift towards easy monetary policy is expected to drive more foreign capital inflows into India. Now, other positive factors for the Indian economy are the expectations of the political stability after the Lok Sabha elections in 2024, the steady decline in 10-year US bond yields, which has turned foreign investors into buyers, and also strong domestic macro fundamentals. Now, next up is India's inflation data. After reaching a high of 7.4% in July, primarily due to rising food prices, the months that followed had inflation easing in the country. However, after declining to 4.87% in October, the month of November saw inflation rising to 5.55%, reaching a 3-month high. But this uptick in inflation print was widely expected. Now, when looked at the breakup, inflation rose on the back of vegetable prices rising as well as non-perishable food items such as cereals, pulses and spices. Now, vegetable prices, especially those of onions and tomatoes, have been worrisome as there is tight supply. The government has also imposed a ban of exports on onions till March 2024 to enhance domestic availability. The upside in inflation was, however, contained due to a drop in oil, fats, fuel and light prices. Now, despite the uptick in inflation, which hit a 3-month high of 5.55%, it still hovers below the RBI's upper tolerance band of 6%. More importantly, core inflation, which excludes volatile items such as food and fuel, eased marginally to 4.2% from 4.4% a month ago and remains close to the RBI's ideal target of 4%. Now, going forward, the RBI expects retail inflation to average 5.6% in the last quarter of 2023 and remain at 5.4% for fiscal year 24 as a whole. Having said that, this is me, Merlin Sana, signing off. Take care and stay invested.
Did you like watching this video? Then download our app, Informed Investor, to watch more such informative and interesting videos.
Equity investments are subject to market risk. Read all investment-related documents carefully. Visit www.researchandranking.com